Welcome to the HIT Podcast, HIT, Human Resources, Insurance, and Technology. I'm your host, Toby Kennedy. As we do every week, we're dropping into your feed on Tuesdays with what we hope are bite-sized, digestible, well-curated conversations going on in the space. This week's episode will be no exception. This week's episode is brought to you by Montage Insurance Solutions, and without any further ado, I get into my conversation with Alden Bianchi. Alden, thank you for joining me, sir.
Happy to do it, Angel.
Yeah, good to have you out. So what I want to do is kind of dive into our topic. And for the audience at home, we are talking about double dipping. And I'm not talking about your guacamole, Alden. I'm talking about double dipping in ways that the IRS might frown upon. But before we get too deep down the road, do you mind just give the audience a quick overview of kind of who you are, what your background is, and I will share an amusing anecdote after.
Okay. So I'm in the Boston office of McDermott, Will and Emery, which is a global law firm that is now, I guess, pretty much New York centric. I've been practicing employee benefits for a very long time, with a principal focus on welfare benefits since the ACA in about 2010. I had the privilege of testifying before the Senate Finance Committee on the lead up to the ACA, and I was Mitt Romney's outside counsel for the development of the Massachusetts Healthcare Reform Act, which ultimately became the model for the ACA.
I remember wanting to do the topic that we'll get into today and waiting until I found somebody that knew a thing or two about it. And then when we met and we talked about it, and I said, Alden, I'm so excited because I wanted to have somebody on that really knows this topic well. And you sort of paused and said, I don't know how to say this without sounding silly about it, but I don't think there's a more qualified person to talk about this. And I said, oh, great, good. We got the right guy. So I appreciate you and I thank you deeply. And I think that, to kind of get straight into it, I have been approached from time to time about organizations who tell me, hey, you should put me in front of your clients, right? Obviously, it's my day job and employee benefits consultants. And they say, hey, we can save them a bunch of money because there's this cool way where we can basically have their employees buy this benefit that's tax-free, and it's super expensive. It's like $1,000 or $1,200 a month. But the good news is it lowers their taxable income a bunch. It lowers your, as an employer, taxes a bunch. And then all they really need to do is just kind of be part of this benefit. And we'll send them a wellness check every month that'll pay them back for the amount of money that came out of their paycheck. So ultimately they're made whole. Ultimately you save money. Ultimately they get some kind of a benefit. And I go, wow, this sounds too good to be true. And then I think to myself, historically when things sound too good to be true, it makes you want to poke around a little bit. And I'm worried before I put this in front of my employers and they only hear from the sales guy, perhaps they should hear from the cautionary guy as well. So can we talk a little bit about this sort of IRS double dipping, what it looks like, where it comes in, and how it's kind of viewed both federally and then any other agencies that may have an interest in this?
Sure, happy to. You want me to start with a little bit of background,
Yes,
what they
please.
are and how they work? Sure.
Yeah.
So the phrase double dipping originated with a 2002 IRS revenue ruling in which an employer not only took a deduction for amounts it paid for health insurance, but it reimbursed folks for amounts that they paid under a cafeteria plan. The result was they took a tax deduction twice in ways that they were valid deductions under both 105B of the code and 125, but they took a double deduction. It was pretty clear if you looked at it long enough that it didn't work. But that was the phrase double dipping first originated. Later on, in around 2006, two rulings in 2016 and one in 2017, and I might have that off by a bit. It might be one year or the other. There were a series of rulings where folks started to use a hospital fixed indemnity type chassis, mixing it with a welfare benefit. And the savings there originally claimed to get an outsized income tax benefit, but then very quickly morphed into focusing on the welfare, on the payroll tax benefit. So the savings was an employee tax savings. And that's what these schemes have really become now. They are any scheme that purports to save you money, a lot of money on employment taxes. If in essence they do this by morphing what is really a wage into a benefit. They would have you believe that every month you are going to incur medical expenses or some kind of welfare benefit. And I want to come back to that distinction because that's critically important and it gets glossed over a lot. That every month you have $1,000 of wellness or medical expenses that you need to be reimbursed for, and that is therefore a benefit that is not subject to payroll taxes as opposed to a wage that is subject to payroll taxes.
It
So,
looks a
so
little bit like the Affleck style plans, right? Is kind of the I guess sheep's clothing they're trying to wear, where they say, hey, these are real legitimate plans that we can sell you, and when you actually incur a qualified expense, then Aflac pays you money, or any work site carrier, right? But Aflac's kind of the name brand in this. So these policies are designed to sort of say, hey, look, just like that, you can buy this policy, and if you have an event that's a covered event, you'll get paid out a benefit, except for the part where they kind of manufacture the covered event.
well, no, I want to make an important distinction
Yeah.
here. I think Aflac might be a good example of how it's done right.
Right.
Aflac
That's
has
what I
a
meant to
yeah, they have
contrast it with.
yeah, they have a legitimate hospital fixed indemnity
Right.
product that pays in the connection with a service. And I don't know that we'll be able to get into sufficient weeds today to talk about whether or not you're being reimbursed for a service or a day in the hospital or something, an event rather than a service. That distinction is important because currently in the individual market, you can be a reimbursed rider, and Aflac is sold a lot in both markets,
Yeah.
whereas in the employer market, you can't. It's where you layer on some, and I want to be very careful about the use of wellness because many of these products use different terms, they're built on an accident chassis as opposed to a hospital fixed indemnity
Right.
chassis. So some get mixed together with MEC plans, so-called minimum essential coverage plans, for reasons that have some basis in regulation. But I wanted to offer two high-level points that I think you have to hear both of them to get the right context. First of all, any program that purports to save a huge payroll tax savings based on some kind of accepted benefit chassis, whether it's accident insurance or whatever, from a tax and regulatory perspective, does not work. Full stop, end of discussion. Now, here's the flip side of it. These programs are becoming ubiquitous. They are being adopted at all levels and sizes of companies. The regulators have been slow to step in and do anything about them. And so now, I'll be honest, I have to be very careful. If I'm advising a hedge fund and the hedge fund says, we want to buy one of these companies, what am I going to say? You don't buy it, and then their competitor across the street scoops it up and makes a ton of money on it? And these things do make a ton of money. So unless either Congress or the regulators step in and do something very soon, these things will become institutionalized. They will become a real thing. And you could literally gut the payroll tax revenues in this country because there's nothing that limits these programs to $1,000 a month. Hypothetically, let's take a high-end architectural firm, boutique firm. You could literally zero out the payroll taxes in the whole company if you make the wellness benefit large enough.
Right. Right.
All right.
So
There's
instead of
nothing
a
that
thousand
caps
dollar a
these.
month
Yeah,
policy, it's
yeah,
a ten
yeah, yeah.
thousand dollar a month policy that
Right.
they get
Or
paid
a
back.
$50,000. Yeah,
Yeah,
right.
yeah.
10,000,
But I
whatever.
guess when you say it might gut the payroll tax, it's like, well, what do I care about the payroll tax? If I'm an employer, I more care about myself. Am I not? Am I at risk of being audited? Am I at risk of doing something illegal? If I'm just an employer, just one employer out there buying these programs,
Yeah.
what's the problem?
Well, that's the issue because you clearly, I mean, these are violations of the tax law. There's no question about it. If any employer sponsoring these programs were audited, they'd have a huge payroll tax liability, and they would have the liability if they don't withhold it. They are liable for both the employer and employee portion of it, and then interest, penalties, and all of that. So the exposure is quite large. There's no question about it.
So the idea is if an employer gets talked into these plans, your very credible advice is PSA, if someone comes knocking someday, you will owe all this back.
Yeah, absolutely. I think I think these involve a huge risk, and let's focus a second on what the risk is,
Yeah.
because many of these programs come with legal opinions,
Right.
and those legal opinions come in two varieties. One are such a joke they don't even matter. The writers of these opinions don't even understand what a legal opinion is. And that's, by the way, there are standards for tax opinions that they have no idea these standards exist, and that these things are absolutely meaningless. Recently, so that's one kind. The other kind, just in the last month or two, found an opinion that actually looks like a validly written tax opinion. Somebody actually understood the tax code. Well, the problem is that the tax issues are only the tip of the proverbial iceberg here. The bigger problem with these programs that I have not seen and I've probably reviewed maybe I don't know, dozen to 2 dozen opinions in this field in the last number of years. Not one has addressed the status of these benefits, the hospital fixed indemnity program, as an HIPAA accepted benefit.
Mm.
That's a very narrow category. And simply because a state insurance regulator stamps the title hospital fixed indemnity on a contract, that's meaningless for federal regulatory purposes. Absolutely meaningless. It doesn't make it so. These programs have a substantial medical component to them, and a wellness component that don't match up with what those programs are. Indeed, back in 2015 thereabouts, the IRS had a couple of items of sub-regulatory guidance that caused an enormous pushback from the NAIC, that they took a very, very narrow view. They really haven't relented. That dispute with the NAIC ended up being more over the individual market than the group market. So under current law, we don't need to have the proposed 2003 junk insurance rule to tell us anything about this. Those products clearly don't rise to the level of accepted benefits. Not one of them that I have seen. It's not even close. It's not even something that reasonable minds might differ. And yet none of the opinions address that issue or claim that these things truly are accepted benefits. And by the way, even in the case of the one opinion that I saw that was written by somebody who actually understood the tax law, the opinion would just it missed a good chunk of IRS guidance.
So long story
So,
short,
yeah.
because they make a ton of money, there's
Mhm.
really no shortage of folks out there trying to knock on the employer's door. But in your highly esteemed opinion, it's a bill of goods.
Yeah, and by the way, I mean I appreciate the modifier highly esteemed. I don't consider myself that. I'm just reading the tax code and reading the benefits law, and I've done this for a long time.
Well,
And at
not
the end of the
everybody gets
day,
invited to
yeah,
Washington,
yeah,
D.C. Not everybody
well,
helps
that's true.
craft,
Yeah, that's true. That's
national
true.
shaping,
Yeah,
changing legislation. Not everyone's outside counsel to Mitt
yeah,
Romney. So,
yeah.
while I, could have
I
stumbled
appreciate it. Yeah,
across any number of folks to
yeah.
help me just put a pin on this and say, indeed, it's a bill of goods. You are someone that speaks with at least a degree of authority on the matter.
Well, I think if there's anything that I mean, I've just seen a lot of these, and we've seen them in trade associations where a particular industry has been targeted. I see them in deals that start to come across my desk, and that's where I've noticed the big spike up in these things. If you go back a couple of years, if you're a benefits attorney in a firm like ours, you're called into deals to do the little benefits piece. You're a bit player in the deals, but they show up, and they showed up on occasion a few years ago. I had a week, a little bit ago, where I think three of these programs showed up in a week,
Mm.
and that's, that's, and then I've had other folks coming to us. Hedge funds have started to look at buying these companies. If you look at the economics, so out of that $1,000 a month, you might have I don't know, 80, $100 might go to the actual fixed indemnity portion. But there might be a good, $50, $100 per member per month that might be available to pay the promoters. That's not a small amount of money. I mean, these things do make a lot of money,
Yeah.
but they really don't work. And the frustrating thing is that you hear the refrain over, oh, no, our program is different.
Yeah. Yeah. Other guys don't do it
Or,
right, but we do.
oh God, that makes me nuts. Or we issue EOBs. Well, yeah, so what? That's a piece of paper with some writing on it. Or the IRS has sanctioned these things because they didn't adopt this one. I love the recent 2003 junk insurance rule, but they didn't finalize it, and therefore they admit that these things work. No, they really didn't. Let's see, what are some of my other favorites here? Oh, the court has gotten rid of Chevron deference, so therefore there's no way we can lose in court. Well, yes, there is. To put this in perspective, of the opinions I've seen, the best of them was written to what's called a reasonable basis standard. That's a 20% chance of success.
Mm.
All right, that's one of the dirty little secrets about legal opinions. They have standards to them. If I say something should happen, then I've signaled that I think it's 80% or better success rate. If I say more likely than not, I think it's just over 50. If I say substantial authority, I might be somewhere around a 40% chance. If I say I've got a reasonable basis, I'm at 20% or less. That's bad.
Yeah.
And that's with that's with what purports to be a solid opinion. So I think that the better question is what is the government going to do about it, and what can they do about it? One of the things they could do, and is just to label them as abusive tax shelters, and that would require them to be reported. I understand from talking to some ex-Treasury officials that the Treasury Department and the service had considered that, but for some reason couldn't get it internally, couldn't get that to happen. I'm not sure what happened. As for the 2003 proposed rule that would have stomped these things out or stemmed them, that's a tri-agency rule, and the rumor is, and this is just a rumor, I have no idea, I'm nowhere near the inside, but the rumor is that it was finally squashed by the Department of Health and Human Services and not by either the Department of Labor or the IRS. I don't know that. That's simply something I heard through the proverbial grapevine, and I'm not sure it matters. The rule wasn't adopted. Now, are there ambiguities under the hood? There is one or two where you can get the slightest bit of purchase. So I want to be careful about this. And it was set out in something called a Green Book, which is the Treasury Department's wish list for legislation a couple of years ago. Two things. One is there is a provision in the current Treasury regulation under 105. It's 105B2, I think, where for ongoing medical claims, it doesn't require substantiation of each medical claim. And the reason for that is pretty simple. If you have an ordinary medical plan, and you're getting claims you're in the hospital, you're getting bills for the surgery and the physician services, you don't have to separately substantiate each one of those. The promoters of this have taken that phrase, and it is unfortunately drafted from the perspective of the government. They really have to do something about that. But to be clear, that's the substantiation of medical claims. If you're paying $1,000 a month for quote unquote wellness, and this was the point of the 2023 General Counsel memo, there's no 105B medical expenses under the hood there. So substantiation is still required.
Yeah.
Then you get into the whole question of third-party payers, and is the third party an agent of the employer or not? And there, I think these rules have been grossly misread. I think there is an obligation to substantiate on the part of the carrier, but these are things that would help by shining a light in.
Yeah. Man, I appreciate your wisdom on this so greatly. And it's nice for us to be able to not only kind of succinctly say, long story short, these things are trouble, but also tease apart some of the ways where someone might come behind us and say, well, actually this, and well, actually that. We try to keep our episodes bite-sized, digestible, and the time always flies when we're having, really wonderful, detailed conversations. Just to get us out, is there any kind of last thought to put a bow on our conversation today that you want to end us with?
I think the ball is in the government's court. Over time, one of the things that I appreciate about both Treasury and IRS is when they have something that is ambiguous, they tend to come out and make some forceful public announcement and then wait a while, let it sink in and not rush in and audit right away. That happened with health reimbursement accounts back in 2002, for example. So I think for right now that this is an industry that has become unstoppable simply because of the amount of money it makes for promoters. It will continue until the government steps in and says something definitive, or until Congress starts to notice the payroll tax.
The money's missing.
Yeah, the money's missing.
I appreciate you so much, man. Thank you so much for your time today. That is all the time we have for you guys on this week's episode. Blessed to be here. Thank you guys for joining us week in and week out. Thank you to our sponsors, TrueHue, Excel Health, Rula, Montage Insurance Solutions, keeping the lights on. We're watching the numbers go up every week. We appreciate you guys joining us. Join us next week. Join us every week. And until next week, make this the best week yet.